Whether you have a $500 account, a $1,000 account, or even a $2,000 account, in this video, I want to explain how to grow a small account. And if you have a large account, I want to go over how to build consistency, focus on a solid trading strategy, and go over why risk management is the most important, going over these tips and tricks that I'm confident will help grow your account. I've made a video like this in the past, and every single trader that has listened to my advice came back to me and thanked me by doing what I'm going to go over in this video, because it has completely changed their trading, and that's the goal with what I'm going to go over right now. Before we get into it, if you're new to my channel, I recommend checking out the link in the description below for my Instagram at amertitrade. It's a good resource where I post daily trading recaps along with things that you're not going to find anywhere else on the internet, such as the basis to this video about growing a small trading account, and these are the major points that I want to dive into. So as I mentioned, if you have a smaller account or a larger one and you're simply looking to grow that account consistently, I personally recommend focusing only on the S&P 500 or the NASDAQ or one or two specific markets. That way you can learn the personality of that market, you can know how it trades, the best time to trade it in, what strategy works the best in the market, what works the best, what doesn't work so well, and you begin to learn the personality of that market or of that stock, and you're slowly going to learn it so well that you're going to be able to trade it consistently and proficiently. Now there's two ways to trade the S&P and the NASDAQ. The first one are options, and you could trade SPY, SPX, QQQ, or NDX depending on what you're looking to trade. And if you decide to trade options, you can have a cash account. And if you have a cash account, you're going to avoid the pattern day trading rule, which is a rule that if you have under $25,000 in your account, you're subject to only 3 trades or less in a 5-day period. However, if you trade options on a cash account, you are not limited to how many trades you could take in a week. You could take 1,000 trades if you really want to. There is no PDT rule with a cash account. Options are also priced based on volume. So when volume is high in the S&P and volume is high in the NASDAQ, that is when options become favorable, because there's no doubt the high percent gains that you're going to get from such a highly leveraged instrument. So what I mean here is, if I were to pull up the options chain on SPY, I can see every single option that I can trade. Simply pulling up at the money contracts, going back to the charts, we have SPY 434 calls, and these had a low of 48 cents down here to the right. Comparing this to the S&P 500 chart to the left, the market bounced off of our buy zone and began to rally. At the lowest point of these options, they were at 48 cents when the S&P came into the buy zone, and by the time the market closed near the high, they went to a high of $3.15. That is a 560% gain on these option contracts. Now, as traders, we are not going to ever buy the low or sell the high. We are just looking to catch a portion of this move. Hypothetically speaking, if we were to buy the market at this level of demand and capitalize on an upside rally in a quick 40-minute period, these went to a high of $1.48, increasing by $1. That is a 200% return in about 40 minutes time trading options. These offer quick percent profits when the volume is high and you get the direction correctly. However, to one up this, we can also trade futures, which in my opinion is the favorable instrument to trade, and I'll explain that. So we can trade ES, MES, NASDAQ, NQ, or micro NASDAQ contracts. These are all futures. And with futures, there is no PDT rule. So if you have under 25K in your account, you don't have to worry about the day trading rule. However, with futures, a margin account is needed, and you have to understand the risks to margin. With margin, it offers us to trade a highly leveraged product with as little as 500, 1,000, 1,500, depending on your broker. So both instruments are highly leveraged. Futures, you need a margin account. Options, you need a cash account. There's no PDT rule with either of them. And in my opinion, futures are a better instrument to trade once you understand the risks involved with margin. Now, if you've been following me for a while, you all probably see me talk about ES, SPY, and you know I do all of my analysis on the /ES chart. Now, why I do my analysis on the futures chart is comparing all three charts here. We have SPY in the top right, we have SPX on the bottom right, and we have ES, the futures chart, on the left side. They are identical. So every single S&P 500 instrument will move with identical price action. I prefer to do all my analysis and all my charting on /ES, the futures chart, because of how liquid it is, because it's a global market, and it's what I have the most success with. And everybody that listens to my advice also will say the same exact thing. Now, why I recommend the S&P 500 and the NASDAQ is simply because they are the most liquid markets in the world. What I mean by most liquid is they are very easy to get in and out. They are a global market. They are easy to read. They are easy to chart. And there are tons of setups on a daily basis. Whereas if you study them and you watch them consistently, you're going to know when the best times to trade are, when the setups really aren't there and you should not be trading, and you're slowly going to get a feel. If you narrow your focus to these names and you learn their personalities, you're going to know when to take the best setups and to when to not trade those setups because the market is not agreeing with your analysis. And it's easy to spot all this because they are highly liquid. Because of their highly liquid nature, price and volume is all you need in the market. The market moves up and down because price changes by the volume coming into the market. So developing a strategy that deals with price and volume will give you the best edge and the highest odds of success. And I'm going to show you a trade that I took. But because of this and how liquid it is in price and volume, it works very well with supply and demand balances, such as looking to play the market long at a demand zone, and such as looking to take profits or reversing the market short at a supply zone. Because they are a global market, they are so liquid, the charts are easier to read, they are not illiquid at all and getting manipulated by like penny stocks will be. They work very well with supply and demand zones, price action, and most importantly, order flow. Order flow combined with supply and demand key levels and price and volume will provide a huge edge, and that is what I have the most success with, such as every other trader that comes to me and listens to this advice. Now, really fast, we have to know how much it costs and what a future contract involves. So we have two sides to this. We have an E-mini S&P and E-mini NASDAQ contract. And then also we have a micro E-mini contract, which is 1/10 of a size of a standard E-mini contract. A full E-mini is a full contract, whereas a micro contract is 1/10 of the size. So on the S&P 500 specifically, $50 is a 1-point increment. What I mean here is if the S&P 500 moves from 4420 to 4421, we had a $1 or 1-point increment. That means we got $50 per 1 point. So 4,000 to 4,020 is 20 points. 20 points times $50 per point is $1,000 per contract. Some people trade with 3 contracts, 5 contracts, 10 contracts, and you just can multiply the numbers. Now, a much safer, a much easier way to manage risk, especially when developing an edge, is focusing on micro E-mini contracts. They are 1/10 of the size, which means they are $5 per 1-point increment. So if the S&P similarly moves from 4,000 to 4,020, that is 20-point difference, we get $5 per point or $100 per profit per contract. It's 1/10 of the size of a standard full E-mini contract. In this example, we have a bounce off of this demand zone into a rally off of supply. It was a 34-point rally in 45 minutes from the low to the high. If we were trading ES, which is the full size contract, $50 per point, 34 points, we are getting a $17,000 profit. And some brokers allow you to trade the S&P 500 with only $500, maybe even $1,500. It's a highly leveraged instrument. With the cash that we put out of our own account, not the margin the broker put up, we are leveraging about 100% return in this example in 45 minutes. Same thing with the micro E-mini contracts. $5 per point, 34 points times $5 is $170 per contract. Some brokers allow you to trade a micro contract with as little as $50. So we're putting $50 of our own cash in. The broker is putting up the rest of the margin, which again, why it is highly risky. However, easier to manage risk. But our $50 can then turn into $170, and this is similar approach with options. Now to the downside, if we were to short this move, it's a 24-point profit off of the supply zone, the pink box. ES, $50 times 24 points is $1,200 profit. You divide that by 10, because again, the micro contracts are a tenth of the value. We get a $120 profit. Now with options, they are harder to manage risk. I will not lie, it's very difficult to get an exact dollar amount of how much you are going to lose if you are incorrect on the options trade, because options move and are priced in because of other things not dependent on price action itself, such as volatility and time. It's also harder to calculate how much money you're going to make exactly because of those factors as well. However, the pro of this is they offer better percent returns. You're not going to find 1,000% return in 20 minutes trading 0 days to expiration SPX contracts like you would on futures. However, with higher reward comes higher risk. With futures, it's much easier to manage risk, and that's something beginners traders really struggle with, is managing risk. And that's why it's so much easier with futures to know exactly how much you're going to make if you're correct on it and how much you're going to lose if you are incorrect on it, which is why I firmly believe trading futures are easier and better for beginners, because beginners cannot implement proper risk management. But trading an instrument that allows you to properly manage your risk will just give you a better approach to your trading strategy. And it's important to manage that risk because, again, you are trading a highly leveraged instrument on margin. Now, regardless of your account size, I don't care if you have 100 grand in your trading account. I don't care if you have $2,000 in your trading account. If you are building a strategy and you are developing an edge, I recommend trading 1 to 3 micro E-mini contracts. Micro E-mini S&P, micro E-mini NASDAQ, regardless of your account size, until you're consistent with that for 2 to 3 months, whereas your wins are at least 2 times larger than your losses. If you can implement 2x wins than your losses consistently for 2 to 3 months, trading 1 to 3 micro E-mini contracts, then all you have to do to scale up and build more profits and make more gains is scale it up. Trading is the most scalable business. If you can consistently make $50, $200 profit, and your losses are 2 times smaller than that for 2 to 3 months, then all you got to do is scale up your position size. Maybe go 5 to 10 micro E-mini contracts. And instead of you now making consistently $200, now you're going to make consistently $500 per day, and your losses are only going to be about $250 or maybe even $200. So scalability is the most important aspect to this. If you're consistent with small size, all you got to do is scale up your position size and you will simply make more money. A lot of traders jump the gun. They go in with too heavy of a position size. They blow it all on 1 or 2 trades. It affects them mentally, and they're not here to trade tomorrow because their account got destroyed. Focus on consistency with small size, trading 1 to 3 contracts, and scale that up once you're consistent. So here's an example of an actual trade that I took, and I first want to go over the pre-market plan so you could understand this analysis. Now, every single day, I post pre-market plans in my Discord of setups I'm watching, levels I'm looking out for, and potential trading scenarios. So scenario number 2 was we were watching 4405 and 4410, which was the supply box that you can see here up in the pink level. Down below, we have a demand zone at 4367 that if the market could hold and pull back at it, I am looking for an opportunity for buyers to support the market to play it long. So we have a demand zone. We're watching buyers there to support price, defend it, and play it long. Now, what's interesting here is as the market opens up, we get a rally in the first 15 minutes. And then after that, we get a strong drop into this demand zone at 4367. Now, briefly going over this, we broke the previous open price low around here, around 4368. So we're breaking the low of day. We're breaking pre-market low. We are also in a demand zone. And one thing I want to highlight is the volume down here is a large green aggressive buying as we come into the demand zone. If there is strong buying inside of a demand zone, it's indicating the market may want to test higher prices. Similarly, if we see a large amount of selling pressure inside of a demand zone and there is a lack of follow through, this indicates the market may trap those sellers to reverse them higher, to bring the market higher, to put those guys underwater. In this example, around 957, 958, we can see over 400, 500 contracts which hit the bid, which are aggressive sellers, as we come into our demand zone, indicating sellers are there, not proving they can bring the market lower, with volume on the red and green volume bars, indicating buying pressure then stepping in for the market to reverse. With this information alone, I put in the Discord that I am trying it long at 4367 demand. I am seeing signs of buying. I will cut it under the low of day at 4366. The S&P 500 was at demand. The NASDAQ was at demand. And we also had an equity such as Tesla also at demand, where I saw enough signs with multiple pieces of confirmation to put risk on. Now, here's the option for you. Whether you could trade options or futures, it really depends on what you prefer and your risk management system. In this example, and 99% of my trades recently have all been future trades because I'm easily scaling it up and it's much easier to manage my risk in the current market conditions with volatility being so low. So the market hits our demand zone, we take it long. We were going for a 4382 breakout. So essentially we were risking about 2 points, which is $50 per contract, or if you're trading the micros, $5 per contract. We were risking 2 points, which at most was $100 or $10 per contract, for a 15-point rally. A 15-point reward for a 2-point risk is excellent risk to reward, and we scaled out on the way up, and our last exit was at the upper target at 4388 for a 20-point rally in about 25 minutes time. So with that trade, if you were to trade futures, 20-point rally in 25 minutes, $50 per point is $1,000 per contract. Some traders trade 3 contracts. That's going to enable $3,000 profit in a short amount of time off of a 2-point risk. Now that example was very, very small risk. But if your risk is at least 2 times smaller than your reward, you're putting yourself in the position to win, and you could afford to be incorrect more than you are correct, yet your risk management system takes care of those losing trades and let your winners speak for themselves. If you were to trade the micro contracts, 20 points times $5, 3 contracts would be a $300 profit off of maybe a $150, $300 initial cash investment out of your account in 25 minutes. Excellent trading with futures, much easier to manage the risk aspect. So really all you need is price and volume, respect your risk, leave your emotions out of it, and solely focus and put your attention to the S&P 500 and the NASDAQ. They are my favorite instruments to trade. It's what I have the most success with, and it's what everybody that listens to my advice will come back to me and say the same exact thing. For example, this member started with futures about 10 days ago. After listening to my advice, following a plan, setting a stop loss, and making sure his risk to reward is at least 2 to 1, he's able to get larger gains than losses, and that's how consistency will come. This member, thanks for the course of lessons on order flow, started with a $2,000 account, and is now sitting above 12K by formulating your own plans and strategy off of the teachings. Thank you, InvestiTrade. This member has a small account, I believe, with $2,000, and now it's sitting at a $1,900 profit with consistency following small account rules. This member risked never more than $500 on a single trade and made a $3,600 profit. Another member, one of the biggest takeaways is correct sizing is key. Used to trade 5 to 6 contracts, but ever since they switched their approach to 1 to 2 contracts, he's been able to respect his stop loss and letting runners get larger gains. So guys, listen to me. Size down to smaller size until you're consistent. You will have less emotions and you will be able to follow your plan much easier. $4,000 profit trading 2 mini contracts. Another member, last month's P&L, consistency. Diving into order flow has been a real game changer for that consistency. Another member, small profit using ES and NQ, focusing on price and volume analysis. And that is what I recommend everybody to do. So I'm going to end it on that note. I want you all to drop a like on this video and comment and come back to it in a few months' time once you have success with it and give me some feedback on how well you're doing with it or any critiques that you may have on this video. But believe me, I'm not here making these things up. If I give this advice to a lot of struggling traders, they see a major difference in their trading, and that's my goal with all of you. But I'm going to end it. Peace.